Silver touched $65 an ounce this week. Then, within hours, it gave almost all of that gain back. A spike and a snapback in the same session doesn't happen during ordinary trading. It happens when several forces collide at once, and the aftermath usually tells you more than the spike itself. Why did it hit 65, and why did it fall right back down almost as fast? Start with something that, on paper, should have pushed silver down rather than up. The government released its July jobs report, and it was bad. Economists expected the economy to add roughly 80,000 jobs. Instead, the report showed a loss of 23,000. Unemployment ticked down slightly to 4.1%, but that number can mislead since unemployment sometimes falls because people stop looking for work, not because they found any. A miss of that size close to 100,000 jobs below forecast is not a rounding error. Normally, weak jobs data points one direction. A slowing economy usually means the Federal Reserve is more likely to cut rates, not raise them. Lower rates tend to support gold and silver because metals pay no interest, so when returns on cash and bonds fall, holding metal costs less by comparison. That's the textbook relationship. But this week, Fed officials did something unusual. Despite the weak jobs number, they've been hinting that a hike, not a cut, could be on the table as soon as September. A weakening labor market and a central bank leaning toward tightening rarely happen together. Here's why it's happening now. Trace it back to the Strait of Hormuz. Tensions there have been building for months and escalated this week. Iran reportedly moved to restrict passage for vessels it considers hostile, and shipping through one of the world's most important oil corridors has gotten shakier. Roughly a fifth of the world's oil moves through that strait. When a choke point like that becomes unstable, oil prices react fast, and they did. Higher oil prices feed straight into inflation, since energy costs touch nearly everything else in the economy, from shipping to manufacturing to a bag of groceries. The Fed is weighing two things that pull in opposite directions. A cooling labor market argues for lower rates to support growth. A fresh geopolitical shock pushing energy prices up threatens to reignite inflation just as it looked like cooling. Raising rates fights inflation but risks accelerating job losses. Cutting rates helps employment but risks letting inflation run hot at the worst possible moment. Neither call is easy. That tension explains the spike and the reversal. When the jobs report came in weak, some traders bought silver on the bet that a rate cut was coming, since cuts have historically helped precious metals. That pushed the price towards 65 within minutes. Almost as fast, other traders recalculated if the Fed is actually leaning toward a hike because of the Hormuz-driven inflation risk, the rate cut trade that just pushed silver higher was built on a bad assumption. That repricing is probably what triggered the sharp pullback. In a few hours, the market told two different stories about what the Fed would do next, and silver's price reflected both. A single data point rarely tells the whole story. Markets are constantly trying to price in not just what happened, but what a small group of policymakers in Washington will do about it. When that interpretation shifts, even without new data, prices can swing just as hard as they do on the data itself. To understand why silver reacted this strongly, it helps to zoom out from 1 week and look at the last 12 months, because this volatility didn't come from nowhere. Silver has had an extraordinary run. Over the trailing year, it's up somewhere around 60%, well ahead of gold's roughly 26% gain over the same stretch. That gap matters. Gold and silver usually move together, just at different magnitudes, so when silver pulls this far ahead, something beyond safe haven demand is usually driving it. Silver isn't only a monetary metal the way gold mostly is. It's an industrial one too, heavily used in solar panels, EV components, and electronics. Part of the explanation for silver's outperformance is industrial demand, not just investment flow. That appears to be exactly what's happening. Chinese imports of silver-bearing ore reportedly jumped more than 60% year over year in the most recent data, tied to solar build-out and grid electrification. That's physical metal being consumed by industry, not a speculative position. Physical demand tends to stick around longer than speculative buying because it doesn't reverse the way a trade does. A trader can sell tomorrow. A solar panel manufacturer that already used the silver can't give it back. Silver's path over the past year wasn't a straight line up either. It touched a 7-month low near $55 in mid-July, just weeks before this spike to 65. That's roughly an 18% swing in under a month. Markets that move that fast in both directions usually have thin conviction and crowded positioning. When a lot of traders lean the same way, even a modest surprise, a jobs report, a stray Fed comment can trigger an outsized move because everyone tries to adjust at once. There's a historical echo worth mentioning, one that comes up whenever silver moves this violently. In the early 1980s, silver went through one of the most dramatic spike and collapse episodes in commodity history. driven partly by concentrated buying that distorted the market. That episode gets cited as a warning about how thin and how easy to distort silver can be compared to a market like gold or oil, simply because the total dollar value of tradable silver is so much smaller. That doesn't mean today is a repeat. Circumstances differ and market structure has changed a lot since then, but it's a reminder that silver, thanks to its smaller size, amplifies moves that would look modest in a bigger market. Now back to gold, because something else has been happening quietly, and it ties into the same theme of shifting monetary structure. Reports say China's central bank has been moving physical gold from London vaults to Hong Kong as part of building a new gold clearing and pricing system based in Asia. For decades, London has been the dominant global reference point for gold pricing, mostly because of its deep liquidity and long-established infrastructure. Building a competing pricing center in Asia isn't a small technical detail. It signals where financial influence may be heading over the next several years. Why should someone who owns gold or silver care? Gold pricing has historically concentrated in a handful of financial centers, mainly London and New York. If a meaningful share of gold trading migrates toward Asia, it could change how gold prices get set and could reduce the pull Western institutions have historically had over that process. This is gradual, not overnight, but shifts like this tend to unfold slowly and quietly right up until they don't. It connects to something broader that's been building for a few years. Central banks, especially in emerging economies, have been growing their gold reserves. China's central bank has been a notable buyer, part of a wider pattern of countries trying to reduce reliance on any single currency or financial system for reserve assets. Central bank buying behaves differently than retail or speculative demand. Since central banks generally aren't trying to time the market, they're building a long-term position, so that demand tends to stick rather than reverse quickly. Put these threads together and you get a market running on several different clocks at once. Short-term, interest rate expectations are whipsawing on economic data and Fed commentary, which explains this week's spike and pullback. Medium-term, industrial demand for silver is running hot on solar and EV production, a structural tailwind rather than a speculative one. Longer-term, there's a slow-moving shift in where and how gold gets priced globally, tied to central bank buying and a changing balance of financial influence between the West and Asia. No single story explains everything happening right now, so it's worth laying out how this could go. The bullish case rests on a few pillars. If the Fed eventually cuts rates later this year, once labor market weakness gets harder to ignore, that removes a major headwind for precious metals, since lower rates cut the opportunity cost of holding something that pays no yield. Add continued industrial demand for silver and ongoing central bank gold buying, and you get a case for higher prices over time, bumpy path or not. The bearish case deserves equal weight. If the Fed does follow through on a September hike specifically to get ahead of Hormuz-driven inflation, higher rates raise the opportunity cost of holding metals, which has historically pressured prices down, at least in the near term. And if energy prices settle and the geopolitical situation cools, some of this week's inflation fear could fade just as fast as it appeared, taking part of the current narrative with it. The neutral case is mostly about timing. The Fed doesn't have to pick an extreme. They could easily hold rates steady in September, effectively punting the decision while they wait for more data, which would likely keep the same tug of war running in silver and gold for weeks or months instead of resolving fast in either direction. Given what's known right now, the case that holds up best sits between bullish and neutral for one specific reason. Silver's industrial demand story doesn't depend on what the Fed decides in September. Solar installations and EV production run on their own multi-year track, set by decisions governments and manufacturers made well before this month's jobs report. That demand offers silver a kind of support that isn't purely tied to rate speculation, even though short-term swings like this week's will keep happening because of Fed uncertainty. That doesn't mean prices can't drop in the short run. They can, especially if the Fed hikes and traders who bought this week's rally on rate cut bets are forced to unwind. Short-term price action and long-term structural demand are different things, and mixing them up is one of the most common mistakes people make after watching one volatile week and trying to draw a permanent conclusion from it. There's a psychological piece worth understanding too, because it explains a lot of behavior in weeks like this one. When prices spike fast, the instinct is to chase, buying near the top out of fear of missing out. When the price snaps back just as fast, the instinct flips to panic, and some of the same people sell near the bottom. Buying high out of excitement and selling low out of fear is one of the most consistent patterns in market history, and it shows up in every asset class, not just metals. This week's volatility had an identifiable cause, a fast shifting red on Fed policy rather than random noise, and knowing that can keep you from reacting to the swings emotionally. So what's actually worth watching from here, if not the headline price swings, watch the September Fed meeting, and more specifically the language officials use in the weeks before it. Markets tend to move on expectations well ahead of the actual decision, which is exactly what happened this week. How Fed officials talk about the trade-off between weak jobs data and Hormuz-driven inflation risk will probably tell you more than the decision itself. Watch the Strait of Hormuz. If tensions ease, oil could pull back, easing the inflation pressure currently pushing the Fed toward a hawkish stance. If tensions escalate, expect the opposite. Watch Chinese silver-related industrial imports and any further developments in gold moving from London to Hong Kong. These move slower, but they speak to structural demand and shifting pricing power, which will likely matter more over the next several years than any single week's price action. There's also plenty we don't know. We don't know how the Fed will resolve the tension between a weakening labor market and rising inflation risk. We don't know how far or how fast the shift toward Asian gold pricing infrastructure actually goes. We don't know whether this week's spike to 65 was an early preview of where silver is headed or a sharp, temporary overreaction to one data release. Anyone claiming certainty on those questions is offering a guess dressed up as a forecast. What can be said with more confidence? Silver's demand story from solar and EV manufacturing is real and isn't going away regardless of the next Fed meeting. Gold's role in central bank reserves is shifting gradually toward a more multipolar structure, and that's been building for years, not weeks. And short-term volatility like this week's tends to come from fast, changing readings of policy, not a permanent shift in fundamentals. If one idea is worth keeping from all this, it's that the important signals right now aren't the headline price swings, they're the reasons behind them, specifically that a single economic data point can flip the market's entire read on Fed policy within one trading session. That sensitivity says something about how much uncertainty is priced into these markets, and uncertainty, more than any single number, tends to drive the sharpest moves. One more thing worth sitting with after this video ends. If the Fed raises rates in September specifically to fight inflation from an energy shock rather than because the broader economy is overheating, would that actually be bearish for gold and silver long term? Or would it end up proving the exact kind of monetary uncertainty that's been pushing investors toward precious metals in the first place? If this was useful, a like helps. And subscribing means you won't miss the next update as these pieces keep developing. There's another video on this channel that goes deeper into the shift in global gold pricing infrastructure, and it pairs well with everything covered here. Thanks for sticking with this one to the end.